What if I told you that one of the poorest countries in South America is sitting on more oil than Saudi Arabia? And what if they could unlock it, flooding the world market with cheap crude and reshaping the global economy overnight? This isn't fiction. This is Venezuela, and the numbers are absolutely mind-blowing. The shocking numbers. Venezuela has the largest proven oil reserves on planet Earth. We're talking about 303 billion barrels of crude oil. To put that in perspective, that's enough oil to fill over 19 million Olympic-sized swimming pools. Saudi Arabia, the country most people think of when they hear oil, has 267 billion barrels. Venezuela beats them by 36 billion barrels. That's like having an extra Iraq and a half just sitting there. But here's where it gets interesting. Canada comes in third with 168 billion barrels, most of it locked in tar sands. Then you've got Iran with 157 billion, Iraq with 145 billion, and Russia with about 107 billion barrels. The United States, despite being one of the world's largest oil producers, only has around 69 billion barrels in proven reserves. Venezuela has more than 4 times what America has in the ground. How did Venezuela get so lucky? To understand why Venezuela is drowning in oil while other countries are bone dry, we need to go back in time, way back, like millions of years back. Oil doesn't just appear out of nowhere, it's basically ancient sunlight that got trapped underground. Here's how it works. Millions of years ago, tiny marine organisms, plankton, algae, and prehistoric sea creatures died and sank to the ocean floor. Layer after layer of sediment buried them. Over millions of years, heat and pressure did their magic, cooking this organic matter into the thick, black gold we call petroleum. But here's the catch. You need very specific conditions for this to happen. You need the right kind of organic material, the right temperature, usually between 60 and 120 degrees Celsius, the right pressure, and enough time. We're talking 50 to 300 million years. And you need geological formations that trap the oil underground, like porous rock covered by impermeable cap rock. Venezuela got lucky because it sits on top of what's called the Orinoco Oil Belt. This is one of the largest heavy crude oil deposits in the world. The geology here was perfect. Ancient seas, tons of organic material, the right depth for heat and pressure, and rock formations that trapped it all. It's like nature's perfect storm, except instead of destroying things, it created a multi-trillion-dollar treasure chest. Other countries weren't so fortunate. Some had the organic material but not the right geological traps. Others had the traps but no source rock. It's basically a geological lottery, and Venezuela hit the jackpot. The supply boom scenario. Now, let's talk about what happens when Venezuela unlocks its massive reserves and floods the global market with oil. Picture this. Venezuela, which currently produces less than 1 million barrels per day, suddenly gets its act together. Investment pours in. Infrastructure gets rebuilt. Production ramps up to 3, 4, maybe even 5 million barrels per day. That's an extra few million barrels hitting the market every single day. When oil supply surges like that, prices drop. Basic economics. More supply, same demand, lower prices. We're not talking about a small dip either. We're talking about potentially knocking 20, 30, maybe even $40 off the price per barrel. Oil that was trading at $80 or $90 could drop to $50 or $60, and that changes everything. Oil is in everything. Your car, your groceries, your electricity, the plastic in your phone, the shipping that brings you everything from Amazon. When oil prices drop, everything gets cheaper. Gas stations lower their prices. Airlines pay less for jet fuel and can offer cheaper tickets. Shipping costs go down, which means the stuff you buy costs less. Manufacturers using petroleum-based materials see their costs drop. It's like giving the global economy a massive stimulus injection. But here's where it gets complicated. Cheaper oil isn't good for everyone. It depends on who you are and what you do. If you're a consumer in an oil-importing country like Japan, most of Europe, or the United States, this is fantastic news. Your cost of living drops. You have more money in your pocket. Economic growth gets a boost because businesses have lower energy costs. But if you're an oil-producing country that depends on high oil prices like Saudi Arabia, Russia, or even the United States with its shale industry, this is a nightmare. Your revenue collapses, your budget gets squeezed. You might have to cut social programs, delay infrastructure projects, or even face economic crisis. For Venezuela itself, the calculus is interesting. They're selling more oil, but at lower prices. Whether they come out ahead depends on how much production increases versus how much prices fall. Who wins and who loses? Let's break this down. In a Venezuelan supply boom scenario, the winners are obvious. Consumers everywhere win big. You pay less at the pump. Your heating bill drops. Your grocery costs go down because transportation is cheaper. Lower-income households benefit the most because they spend a higher percentage of their income on energy and transportation. This is basically a massive tax cut for ordinary people. Industries that use a lot of energy are also winners. Airlines see their fuel costs drop and can lower ticket prices or boost profits. Shipping companies save billions on fuel. Manufacturers who rely on petroleum-based materials or energy-intensive processes see their costs plummet. Entire industries like plastics, chemicals, and transportation get a huge boost. Oil importing countries like Japan, South Korea, India, and most of Europe benefit enormously. Their trade deficits shrink because they're spending less on oil imports. Their economies grow faster because energy costs drop. Their currencies might strengthen. It's a geopolitical gift. On the losing side, you've got other oil producers. Saudi Arabia and Russia see their revenues collapse. The U.S. shale industry, which has high production costs, becomes unprofitable. Rigs shut down. Workers get laid off. Countries that built their entire budgets around $70 or $80 oil suddenly face massive deficits. Some might face economic crises or political instability. Oil companies take a hit too. Lower prices mean lower profits. If you own shares in ExxonMobil, Chevron, or BP, your portfolio might struggle. High-cost producers go bankrupt. Investment in new oil projects dries up. And then there's the environmental angle. Cheap oil is terrible for the climate. It makes gasoline-powered cars more attractive than electric vehicles. It slows down the transition to renewable energy because solar and wind have a harder time competing with cheap fossil fuels. Governments might delay climate policies because there's less political pressure when energy is affordable. How could you make money from this? Okay, so here's the big question. If you see Venezuela ramping up production and flooding the market, how could an ordinary person potentially profit? And let me be crystal clear, I am not a financial advisor. This is not financial advice. This is purely educational. Always do your own research and consult with a licensed professional before making any investment decisions. That said, let's talk strategy. If oil prices are about to drop because of increased supply, you want to bet on the beneficiaries of cheap oil, not oil producers. Airlines are an obvious play. Lower fuel costs mean higher profits. Companies like Southwest, Delta, or United could see their margins expand significantly. You could buy airline stocks or ETFs that track the airline industry. Shipping and logistics companies are another option. FedEx, UPS, and ocean shipping companies all benefit massively from lower fuel costs. Their largest expense just got slashed, and that flows straight to the bottom line. Consumer discretionary stocks also benefit. When people pay less for gas and heating, they have more money to spend on everything else. Retailers, restaurants, entertainment companies, they all get a boost. You could look at consumer-focused ETFs. There's also the industrial play. Manufacturing companies that use a lot of energy, chemicals, plastics, or transportation see their costs drop. Companies in these sectors could see profit margins expand. If you want to bet directly on falling oil prices, you could short oil through inverse ETFs or put options on oil futures. But this is incredibly risky. You can lose a lot of money very quickly. Timing is everything, and oil prices are notoriously volatile and unpredictable. Another angle is emerging markets. Countries like India, which imports massive amounts of oil, benefit enormously from lower prices. Their economies grow faster, their trade deficits shrink, and their stock markets could boom. You could invest in Indian ETFs, or other oil-importing emerging markets. And don't forget Venezuela itself. If the country stabilizes and production ramps up, Venezuelan assets might be worth looking at. Bonds, maybe even stocks if their markets open up. But this is extremely high risk. Political instability, sanctions, and corruption make this a gamble, not an investment. But here's the reality. The average person isn't going to time the market perfectly. Professional traders with billions of dollars and sophisticated algorithms get this wrong all the time. So if you're thinking about making a play based on oil markets, start small, diversify, and never invest money you can't afford to lose. The Venezuela wildcard. So where does this leave Venezuela? The country has the oil. It has the potential, but it's been crippled by political instability, economic mismanagement, corruption, and international sanctions. Production has collapsed from over 3 million barrels a day in the 1990s to barely 700,000 barrels today. But what if things change? What if sanctions lift? What if there's political reform? What if investment pours back in? Venezuela could become a major player again, ramping up to 4 or 5 million barrels a day or more. That's enough to flood the global market and send prices tumbling. We're talking about a country with more oil than Saudi Arabia finally living up to its potential. Imagine a world where oil drops to $50 or $60 a barrel and stays there. Gas prices fall. Inflation cools down. Economic growth accelerates in oil-importing countries. But oil producers struggle. The U.S. shale industry contracts. Saudi Arabia and Russia see their influence wane. The entire geopolitical landscape shifts. The truth is, nobody knows if or when this will happen. Oil markets are influenced by geopolitics, technology, environmental policy, and sheer unpredictability. Venezuela could remain stuck in its current crisis for decades, or it could turn things around in a few years. What we do know is that Venezuela is sitting on a resource that could reshape the global economy, and in a world that still runs on oil, that makes it a country worth watching. So keep your eyes on Venezuela, because when it comes to oil markets, the biggest game changers often come from the places nobody's paying attention to. And if Venezuela unlocks its reserves, the world is going to feel it.